main control, or is that the main control?
Either one should work. We're gonna go and get the podium key, so I will go upstairs and check.
Okay.
All right.
Your cell phone for just a moment. I just need a light to shine on. Do you have a cell phone or something that I can put a light on? Something that you can just shine on the keyboard so I can type. Oh, there you go. Okay, thank you.
Let's make a quick announcement before we start.
The mic's live, but everything else is dead. Can you hit the projector? The projector, this is not working. Only the manual light's working, but this one's not working. Is that a projector? I think it is, okay. Thank you. When is this all okay? Thank you. Thanks. What's making you?
Hey guys, I just wanted to make a quick announcement to invite you all this Friday to the 14th Annual Simmer Conference from 10 to 4 here in KMC. We have a good list of panels and speakers from various hedge funds and buy-side firms talking about investing in the current markets, how they're finding opportunities, and sharing investment ideas and feedback for students. So our keynote speakers are Andrea Frazzini from AQR and Michael Mabusin from the head of global financial strategies from Credit Suisse, who actually Professor DeMotorin will be introducing at the conference. And some panels on activist investing, strategies in equity investing, and emerging managers. Most importantly, the cost for the conference for Simmer members, it's $25, and for non-Simmer members, it's $35. Again, it's you can sign up on campus groups, and it's this Friday, 10 a.m. Thank you.
Thank you. Case, reminder again, case is due a week from today. I keep doing this because I know that if I don't do it, you might never take a look at it. So if you haven't started, get started. If you started, well done. If you're finished, even better. Okay? So keep working on it, right? So let's pick up where we left off. We looked at the Rio Disney theme park, right? We looked at the accounting return, which said the project was not that good. Then when we did cash flows and incremental cash flows, and looked at the time-weighted incremental cash flows, net present value and IRR, the project looked like a good project. But let me step back. When I gave you the initial numbers for the Rio Disney theme park, I gave you the initial investment, then I gave you expected revenues for the next 10 years and expected expenses for the next 10 years. Just like I had in the Apple iCar case, I've given you all these numbers about the future. I don't have a crystal ball. Every single number in there is an estimate, right? Even if you're right in the heart of an action, if you're doing a valuation or a capital budgeting project, even if you have every piece of information in front of you, you're making estimates about the future. You're saying, so what? Could you be wrong? The one answer I never want to hear is, no, I can never be wrong, because you will be wrong, not because you didn't do your work, but because the future is uncertain. In fact, if you think about that $3.3 billion we got in net present value, that could very quickly shift, right? It could shift because revenues might be much lower or higher at a Rio theme park than you expected. Your costs could be different. Your tax rate can be different. The country risk. I mean, imagine building this in Brazil in 2012 when everything looked great. And in 2014, you look back and say, what the heck have we done? Right? Everything can change. And that is the nature of the process. You cannot fight it. And one of the things I think we need to get comfortable with in corporate finance and valuation is accepting the fact that once you're done, you're still not certain. And that's very difficult for some people. I'll tell you what kinds of people it's most difficult for. If you have a quant background, you're really good at algebra through high school, you became an engineer or a mathematician, you're used to precision, right? When you're done, you're done. You have the answer. That is the right answer. It's not up for debate. It's very uncomfortable for somebody who's precision driven to actually value a business or do a capital budgeting analysis. Precision is your biggest enemy because you want precision and it's not there. So let's assume you do an analysis. You take a project, you project the cash flows, you come up with a net present value. You know there's uncertainty. I'm going to give you some potential ways in which you can deal with this uncertainty. Tell me whether this is the path you would take. You can wait for the uncertainty to be resolved. In which case, what are you going to be doing? Waiting forever. So you can wait for Greece to get resolved, and guess what? There'll be Portugal. And you can wait for Portugal to be resolved, and there'll be Brazil. And you can wait for Brazil to be resolved, and there'll be a banking crisis. There's always some other. You're never going to be in a position where everything is certain. So don't do that. If you do that, you're going to end up with all your money in cash. And some companies do this. Let's wait, let's wait, let's wait. Maybe things will get more stable. Second is you can say, if there's uncertainty, I will not take the investment. That's just as bad. Because effectively you're saying, I'll invest in only something that is absolutely guaranteed. And you're actually going to be a target for every con man out there because you want guaranteed returns, but you don't want to make the kinds of returns that go with those guarantees, which is like 0.5%. You want to make 7% and you want guarantees. That's why Bernie Madoff loves you. You can ask someone else, a consultant, an investment bank. It's not going to make the uncertainty go away. What's the benefit of calling in somebody from the outside? If something goes wrong, you can say, well, McKinsey told me to do it. This is the biggest reason consulting firms exist. I mean, let's face it, you're not getting some deeply profound advice from a consulting firm. They're telling you common sense things. But it's easy to pass the buck if you can say, it's an extremely cowardly way to run a business. I pay you millions of dollars to be the CEO of the company. And what do? You call in McKinsey, you pay them hundreds of millions more and say, hey, you know what, wasn't my decision. Goldman told me to buy this company. McKinsey told me to take this project. You can be one of those very unusual people who can completely ignore uncertainty. It doesn't faze you in the least. There's a part of your brain that's actually gone. In fact, it's been studied when people do brain scans, great gamblers and great traders seem to have a piece of their brain missing. It's not a bad piece. It's a piece that actually is the emotional piece, so they can work purely with numbers and just go right. And in fact, the one bad thing is they share that loss with psychopaths. Okay? I'm not saying traders are psychopaths, but there is that portion of the brain, that animal portion of the brain that's been developed over time that they miss, and they can say, I don't care about it. So they're the ones who can sit at the poker table, have their entire wealth on the table in front of them. They don't show, they don't blink an eye. It's okay. I'm afraid none of those four work for me. So I'm going to give you some of the ways I try to deal with uncertainty, because every time I value a company, every time I do a project analysis, I know I'm going to be wrong. Here's the most old-fashioned and long-standing way of dealing with uncertainty. This is a big project, right? Disney's investing, what, $5 billion. So when your project goes bad, you have a lot of money that you've lost. So at the minimum, wouldn't you like to get at least your money back? I know it's a very low threshold. But once you get your money back, you view everything else as gravy. So here's the first question you can ask. How many years will it take me to get my initial investment back? That's called payback. It's been around for as long as people have been investing. And essentially, here's what I'm going to do. I'm just going to count my cash flows. Remember those incremental cash flows? I can keep adding them up. I'm going to accumulate the cash flows to see when I pass zero. What does that mean? Basically, I make my money back. In this case, it takes about 10.3 years, if you want to be precise, or roughly 10 years, to get your investment back. You're saying, what do I do with that? Many companies that use payback have a threshold on payback. They will not take projects that take more than 5 years or 7 years or 10 years to pay back. There are companies out there, and you're going to see these in the surveys, that base their entire investment decision on payback. They want to get their cash back sooner rather than later. So payback is a very simplistic device. But with payback, all you're doing is getting your initial investment back, right? That doesn't make you whole again. You know why? That money invested elsewhere could have earned you a return, right? How much? You took a risky investment. You'd have earned the cost of capital. So effectively, if I take the discounted cash flow, it takes me almost 17 years to get my money back. Again, by itself, it might mean nothing. But if I have a threshold and this is higher than the threshold, I will not take the investment. So 40 years ago, if you were doing capital budgeting, this was probably the only thing you could do, because everything was done on paper. You had to add numbers up. You really couldn't do a lot of what-if analysis. In fact, I remember my summer of my MBA. It was 1980. And I was at UCLA summer, and you couldn't get jobs. 1980 was one of the worst recessions ever. And I finally got a summer job with the company called Watermark, a company you've never heard of, but it had one product. It was a radio show. What it did was it produced a radio show that it syndicated. You know how syndicated radio shows work? You make a radio show and you sell it to stations, and they pay you every week. This was actually a very popular radio show. Some of you might even have heard it. It's called American Top 40. It's still around. If you drive anywhere in the US on a Sunday, you'll hear American Top 40. It's an extremely creative concept. Here's what they do. They take the top 40 songs of the week and they go number 40, number 39. That's the most innovative part, is they start with the last song and work your way to the first one, and you just can't wait for the suspense to end. So there are people who say, I can't stop till I get to number one. It was sold to 425 stations, each of whom paid $1,000 a week. So it's a small business making $425,000 a week. So why did they need you? They really didn't, but they were thinking about creating a second show. They're ambitious now. The show they were going to create was called Soundtrack of the 60s. Remember, this was 1980, so guess what they were going to do? They were going to go back 20 years, take a week from 1960, take the top 40 songs from that week. You don't stray too far away from your preferred expertise and play them down. So this was for the old people in 1980 who want to listen to 60s music. And my job was to come in and assess whether they should take the show. I was completely naive. I'd taken a one corporate finance class, and I remember the first day I walk in, it's a small business right across the street from Universal Studios in Burbank. Okay. I walk in and said, where are the cash flows? Because every problem I'd ever seen in a textbook came with cash flows. They handed me a ledger book. Have any of you guys seen a ledger book? It's a big book which goes sideways with columns already in it, so you don't have to draw the columns. And there was nothing on it. And I said, what do you want me to do with this? They said, we've hired you to come up with the cash flows. I said, what the heck have I gotten myself into? But I knew I had about 8 weeks and I had to get started. Now, how do you get revenues from the show? You sell it to stations, right? So the first thing I needed to figure out was how many stations would buy Soundtrack of the 60s. I'm not a radio maven. I have no idea who's buying what. So I went to the marketing guy who hated me from the moment he saw me. I was a numbers person in a creative. Have any of you guys been there? If you're a numbers person in a creative business, it's almost like you have rabies. They're afraid you bite them with the numbers or something. He acted like he didn't even see me. For 3 days, I hung out outside his cubicle. This is how small the business was. The CFO had a cubicle. I had an even smaller corner of a cubicle. So I hung out asking, I wanted to know how many stations. After about 3 days, he realized I wasn't going to go away. He said, what do you want? I said, I need to know how many stations you think you can sell Soundtrack of the 60s to. He said, I don't know, 200, 300, 400, something like that. And I knew this was the most I was going to get out of him. So I walked back to my corner of a small cubicle, and I got my ledger sheet started. Base number of stations, guess what I used? And he said 200, 300, 400. Let me go with the 300. That's a middle number. And that got my revenue started. Then I was off to the races. Every line item was like pulling teeth, but I got a number from somebody. I filled the entire ledger sheet out. Got the cash flows. Came up, I don't even know how I came up with the cost to capital. I discounted all back. I came up with a negative net present value 7 weeks into my internship. I'm extremely proud of myself. I asked for a meeting with the CEO, which is really 3 guys around a coffee table. You know, so it's not like some elaborate process where I have to take the elevator. I just had to walk across from one cubicle to another. And he had 2 directors with him. I said, okay, show us the numbers. I go through the numbers. And this was supposed to be my climactic moment. And I tell them the cash flows deliver a negative net present value. They should not do the show. They take a look at each other and they turn to me and say, what would happen if you tried 400 stations? My stomach dropped. This isn't an Excel spreadsheet. This is a ledger where each number is being worked out by hand, right? If I change 300 to 400, every single number on that sheet has to be changed by hand. So I said, why? They said, we've already decided to take the show. We just want you to confirm it for us. I said, you hired me for 8 weeks for a decision you've already made? I thought at that time it was because they were a small business and they were not being very scientific or sophisticated about the decision process. But I have some really bad news for you. This is the way most decisions get made. Somebody decides to do something and then they look for ways to justify what they've already decided to do. They decide to acquire a company for $15 billion. They come to you and say, well, justify this for me. Well, you did the stupid thing. Why should I be justifying it? But if you work for that person, you've got to come up with the numbers. But it is true, asking what if questions has become remarkably easy, right? Today in an Excel spreadsheet, changing 300 to 400 tick. You want to change the cost? Change that. You want to change both at the same time? Not a problem. You could probably write macros to do it for you. And I think it's actually become too easy. That sounds like a weird thing to say. I see analyses and valuation where 70% of the time is spent asking what if questions. What if this? What if that? What if this? And sometimes you lose focus on what the end game here is. It's not to fill up more exhibits and more scenarios. It's to make a better decision, right? So let me suggest a couple of things to you when you ask what if questions. This is not just about the case. It's about doing valuation, any kind of analysis. First, when you ask what if questions, keep it narrow. Don't ask what if about every input into a process. You might have 50 inputs into evaluation. Focus on the 2 or 3 variables that you think matter the most and you control. So margins, revenue growth, maybe you control those. Ask what if questions about those. Don't ask what if questions about things you don't control. What if exchange rates change? What if? Yeah? What are you going to do about it? So what if questions should be narrow. And when you present your results, remember that a decision maker has to be able to use what you've done in your what if analysis and make a better decision. And the worst way to present a what if analysis is as more tables, more scenarios, hundreds of tables. I mean, I don't know about you, but at about the second or the third table, my mind shuts off. So if any of you on the case are going to deliver 35 tables, what I'm telling you up front is tables 1 and 2 I will look at, tables 3 to 35, I'll act like they're not even there. Not because I don't like you, but the brain can't deal with that many numbers. In fact, if you want to present your what if analyses in a creative way, you want to show it as a picture. You say, that's easy, insert chart in Excel. Another deadly device. You can insert a chart no matter what, right? I've seen charts of 2 numbers. Revenues last year, revenues this year. I don't need a chart. Why don't you just give me the 2 numbers? 2 big columns next to each other. Give me no information. You can make them red. You can make them 3-dimensional. You can make them round. You can cut. It doesn't make a difference. In fact, if you want to see some really good charts, I'm going to make I don't recommend too many books because I know you don't have the time to read those books in the semester. But one of my favorite books is a book called The Visual Display of Information. It's written by a guy called Tufte, T-U-F-T-E. Okay? So if you go to Amazon, just type in T-U-F-T-E and all the books that he's written should come up. Visual Display of Information is one of his first books. And it's about great pictures of data through time. Stories told by charts. And in that book is my favorite graph of all time. It was actually about 150 years old. Somebody actually drew this graph by hand. So this is a pre-Excel graph. And what this graph shows is the ill-fated attempt by Napoleon to invade Russia in the 1800s. So this is 18-something. Napoleon wakes up and says, I want to invade Russia. What this fixation with invading Russia for Europeans is, I have no idea. It's big, it's out there, let's invade it. So Napoleon gathers together this big French army and starts marching. So there's the army leaving. So the width of this graph here is the size of the French army leaving Paris. So there it is, leaving Paris. Lots of ceremony. Napoleon in front on a horse, everybody else walking behind. These were the days of infantries, you know. So and there he is walking across Europe. You think, what are these little tangents? He gets distracted. He invades Poland along the way. I mean, there are all these countries along the way, so let's invade that, you know, let's move through. And he keeps marching, and he gets to the outskirts of Russia. Moscow is still a long ways off, and he keeps marching. And he notices it's getting colder. Checks the calendar, it's getting to be October, November. Around December 15th, he's in Moscow. Victory, right? In the outskirts of Moscow, he can't get into the city. He says, this is really cold. I want to go home. So there he is, turning around, going back. So now the black is the French army leaving Moscow, going back. And in fact, if you look at this axis, that's a temperature dropping as they march back. And as the temperature drops, guess what's happening to the French army? I don't know what happened to this tangent. Those were probably people fleeing, saying, I want nothing more with this army. And then by the time it ends up in Paris, it's 3 guys carrying Napoleon in. This is a great graph. You don't have to show Napoleon's ill-fated. All you have to tell me is how your project will do if margins are different, right? We have much narrower missions. If you can find a creative way to present your what-if analyses, better decisions will come out of it. So that's the second way to deal with uncertainty, is take big variables. The variables that I call them driving variables. The variables that drive your value, and ask what-if questions about that. There's a third way, and this actually is something you could not have done until about 10 years ago. When you do a capital budgeting exercise like we did with the Rio Disney theme park, one of the problems we face is I ask you for point estimates. You know what point estimates are? I ask you, what do revenues grow by? You've got to give me a number, 8%. And part of you is screaming, but I'm not that certain. It could be 3, it could be 15. In other words, we think in distributions, but I insist on a point estimate. So whether you do valuation or capital budgeting, we work with point estimates. Wouldn't it be neat if I allowed you to give me a distribution for each variable? Let me give you an example. The Disney analyses, I gave you revenues for the next 10 years, but those were my estimates. But because this theme park is in Rio, my revenues could be too high or too low. In fact, let's assume that revenues could be uniformly distributed from 20% below my estimates to 20% above. You know what uniformly means? Basically, there's an equal chance that revenues could be 20% below estimates or 20% above. So let's say I put that in as a distribution. I'll give you my base revenues and I say this is the distribution. In my base case, I assume that the expenses at these theme parks would be 60% of revenues because that's what it is in Disney World and Disneyland. But this is in Brazil. I have no idea what the expenses will be. So let's assume that the 60% is my base case, but I could be very wrong. It could be as low as 40% or as high as 75%. So basically, there's a distribution. That's called a triangular distribution. The peak is my base, but there's a chance that I could be wrong. And then for the third thing I worry about is the fact that this is a Brazilian investment, and Brazil's gone through good times and bad times. My country risk, which I used, was 3%, but it could be higher or lower depending on what happens to Brazil. So let's assume I made that a normal distribution. So now instead of giving you numbers, I've given you a distribution. So what am I going to do with this? Have you ever done a Monte Carlo simulation or seen it done? You know what you do in a simulation? The way I would start simulations is actually much more descriptive than the way you see it now with software. The statistics professor actually taught it to me, came in with 3 glass jars. And he wrote out on sheets of paper outcomes that can happen. So revenue jar, the cost jar, the risk jar. And then he put his hand into the first jar, he pulled a number out. So you take a piece of paper, that'll give the revenues from the project. Take a piece of paper from the second jar, that'll tell the expenses. Take a piece of paper from the third, that'll give the cost of capital, compute a net present value. Then drop those pieces back into the jars. That's critical. It's sampling with replacement. You can't take the papers out, put it back, do it again and again and again. How many times? How about 100,000 times? Now if you were doing this with glass jars and pieces of paper, obviously not going to do it 100,000 times. But that's what a typical simulation runs. It runs 100,000 cases with outcomes from the distributions and comes up with a net present value with each one. So you're going to get 100,000 net present values for one project. You're saying, what the heck am I going to do with 100,000 numbers? Rather than give you the 100,000 numbers, I give you a distribution of net present values. Remember, you're the decision maker, right? Before I gave you one number, 3.3 billion, take it or leave it. Do you see the added information I've given you? What else do you now know about this project besides the net present value? The base case, if I look at the median across the 100,000 scenarios, I have about 3.3 billion. So it's roughly the same thing. Why did we go through all this work? Here's your worst case. You could lose about $1 billion. Your best case is you could make 9 billion. So embedded in your simulation are your worst case and your best cases. You don't have to do worst and best cases. What's the thing you worry about most with these big projects? That turns out to be a bad project, right? Can you tell me the probability that this project is going to be a bad project? What would I need to do? Just count the number of outcomes below 0. There's about a 10% or a 12% chance that this project could be a bad project. By looking at the simulation, you learn a lot more about the project. And sometimes you might make bad decisions based on knowing a lot more, but it's good to know more than less. So in this case, rather than give you just one number, I'm giving you a distribution of numbers. Yes?
Don't those variables have to be independent?
Well, those variables don't have to be independent because if your simulation is from a good enough program, it allows you to set up correlations across the variables. Right? Crystal Ball, which is actually available to you on Excel, it's an add-on to Excel that you can use. I think you can use it downstairs still. is actually an add-on to Excel that allows you to convert any Excel spreadsheet into a simulation. It's actually neat because it's a really, really quick learning curve. You add it on, in 2 minutes you'll be doing simulations. Okay? The only problem is, what are the things I'm going to ask you? When I ask you what's the revenue growth going to be, I'm going to ask you what type of distribution do you want me to use? And Crystal Ball will give you a choice of 55. And you're going to look at them and you say, never heard of that one. Never heard of that one. Bernoulli, chi-squared. Oh, this sounds like Greek to me. Oh, normal. That sounds like something I've heard before. An amazing number of Monte Carlo simulations. Everything is normal because that's the only thing you recognize. So if you're going to go down this route, at least invest a little time and resources reading about different kinds of distribution. And I'll save you some trouble. You don't have to read this from a statistics book because those are painful to read. I took a statistic that actually compressed what I could get out in distributions into a paper on my website on finding the right distribution for a variable. So at least give it a browse. It'll take you about 30 minutes. At least you have a sense of what to pick. But it's garbage in, garbage out. It'll be great looking garbage out. But if you just pick distributions at random and throw in numbers at random, you'll get a great looking output, but it'll mean absolutely nothing. Okay? As I said, 20 years ago to do a Monte Carlo simulation, I'd have had to find a mainframe and pay thousands of dollars to do it. Today with Crystal Ball, I can do it for nothing. In fact, you can download a free trial copy of Crystal Ball from Oracle, which is the parent company for Crystal Ball, for a 30-day trial run. And as students, I think you can buy it for $100. Once you stop being students, it climbs to about $700 or $800. It's an investment well worth making no matter where you go, whether it's marketing or finance. Any area where you face uncertainty, which is pretty much every area, simulations are a very effective tool. Any other questions on? So let's see how we'd use this distribution. So you're the decision maker at Disney. The net present value is $3.3 billion. I've now told you, based on the simulation, there's a 10% chance this project could be a bad project. So let me ask you what you're going to do with this 10% piece of information. First is, you'd say, I'd accept the investment, print the results of the simulation to show the world that you did due diligence. That's cover your rear end kind of managing. Nothing wrong with that. The second is, I would reject the investment because there's a 10% chance of failure. Why is that a dangerous road to go down? There are two problems with it. Tell me what the problems are. Because the net present value is positive, but the simulation is saying there's a 10, 20, and you can raise the threshold, 25, 27% chance of failure. Why is using that as a reason to reject the project a dangerous decision? First, let me ask you a question. If I went around this room and each of you was the decision maker, you're looking at those numbers and you're making decisions, right? Those who are risk averse are going to be rejecting the project. So first is, I leave this at your mercy. Because if you're risk averse, the 10% sounds like a huge number. If you're not, it doesn't sound like much. The second is, I think you're double counting risk. In what sense? How did I come up with the net present value for the project? I used a risk-adjusted discount rate, right? The net present value is already a risk-adjusted number. If you start throwing in second and third dimensions of risk, you're actually double or triple counting risk. To me, simulations are useful more for how they help you manage this project in the aftermath than in changing your decision on the project. In other words, if you know that your worst case scenario is minus $2.5 billion and you know you're a small company that can't afford it, you know what you should do? Get a joint venture partner. Get somebody who's got deep pockets to come in. If you know what's making the net present value of $2.5 billion is that if you negotiate with the union and they demand a much higher wage, you can't survive it, maybe you'll start that negotiation before you take the project and try to... In other words, to me, the most useful aspect of simulation is how it helps you manage this project in the aftermath. So 3 different ways of dealing with uncertainty. One is to do the payback. The second is to ask what-if questions. The third is to do simulation. Please don't get carried away with the simulation on your case. I know you can use Crystal Ball, some of you can, but I've given you no information on distributions. If anybody in your group says, let's do a simulation, either they're going to be out there doing an incredible amount of grunt work, collecting data. Okay? So this is more for your general purposes, so it's not specific to the case, but it's an interesting and it's a way that we can deal with uncertainty that we couldn't have used probably a decade or 2 ago. So the analysis for Disney was based on pre-debt cash flows. Do you see what I mean by pre-debt cash flows? I looked at operating income before interest expenses. I looked at cash flows before debt payments. I discounted those cash flows back at a cost to capital, which includes both equity and debt. I came up with the net present value to the entire company. So everything was done through the framework of looking at the entire business. So what I'd like to offer you is a second way of doing investment analyses. And if you do it right, you should get roughly the same answer. It's to wear blinders and think about just the equity investors in your company. You're saying, what does that mean? Look at the cash flows and earnings to equity investors, which is going to be after interest expenses, after debt payments. And if those are the earnings and cash flows you're looking at, the hurdle rate you should be using should be a cost of equity. So everything is done through the eyes of the equity investors. The decision rules still stay the same. You still have to have a net present value that's positive, an IRR that exceeds your hurdle rate, but now everything is done through an equity lens. So let me give you a second project where I'm going to use this process. I talked a lot about Disney. Let me switch gears. Let's assume that Vale, a Brazilian mining company, but really a global mining company, is thinking about investing in an iron ore mine in Canada. In fact, that's based on a real fact. Vale is actually investing a fair amount in Canada. Here's what the details of the mine are. The mine will require an initial investment of $1.25 billion. So I'm going to give you the numbers all in US dollars. And is expected to have production capacity of 8 million tons of iron ore once established. So once the mine is in full force, 8 million tons will be produced. The initial investment of $1.25 billion will be depreciated over 10 years down to a salvage value of $250 million. Notice I didn't have a salvage value with the theme park. What's salvage value as opposed to the theme park? What did I do after year 10? I assumed it would continue forever, right? Why am I not doing the same thing with an iron ore mine? It's a natural resource. Once the iron ore is done, what are you going to keep digging for? Maybe you'll hit gold, but it's very unlikely. So here, once you've gotten through the iron ore, there's nothing left. And I'm probably being optimistic, assuming you get the $250 million. But let's assume you will get $250 million back at the end of the 10th year. Okay? The mine will start production midway through the next year, producing 4 million tons of iron ore in year 1, increasing to 6 million in year 2 before leveling off at 8 million. And the price in US dollars per ton of iron ore is $100. And therein lies the story, because when I did this, it was $100, and it's expected to keep pace with inflation for the life of the plant. So basically, it's an iron ore mine in Canada. I've given you the numbers for the investment, and I've given you the numbers for the price of the iron. The variable cost of production, including labor, material, and operating expenses, is expected to be $45 per ton, and there's a fixed cost of $125 million, which you're going to have to pay whether you produce 1 ton or 1 million tons. Those costs will be in Canadian dollars, but for the purposes of my analysis, I'm going to assume parity. If not, I'd have to do exchange rates on those. Okay? And interest rates and inflation are similar in the two currencies. So I made my life a little simpler, but you can see what I'd have had to do if that had not been the case. The working capital requirements are estimated to be 20% of revenues. Investments have to be made at the beginning of each year. Why is that significant? Because it's going to affect the timing of when I invest in working capital. Beginning of the year means I've got to invest a year before my revenues go up. I can't wait till the revenues go up and then invest in working capital. Vale's corporate tax rate of 34% will apply to the investment. So here's what I'm going to do. I'm going to look at this project through the eyes of equity investors in the project, which means I have to look at what's left over after I've made my debt payments, right? And because I have to do that, I have to first figure out what the debt payments will be. Something I did not have to do in the Rio Disney theme park, because I did everything pre-debt. So here's the first thing I did. I looked at how much they're going to borrow. And so in this case, they were going to borrow $500 million at a cost of 4.05%. And this is going to be a term loan. You know what a term loan is? A mortgage is a term loan. You pay off the loan in equal annual installments. So basically, it's interest and principal in every payment. Yeah.
Why do you use the corporate tax rate and not the tax rate from Canada?
That's a good question. It depends on how the Brazilian tax law is structured, I guess. So you could probably argue, in this case, the Canadian tax rate is 32 or 31%, so it's pretty close. But that's actually an excellent question. Brazil doesn't have the same kind of insanity that the US has of taxing Brazilian companies at strange tax rates. So it is entirely possible that if they're in a 15% tax rate locale, that the tax rate could have been 15%. So here's what I did. I took the $500 million loan. It's a term loan. So each year I'm going to pay $61.8 million to pay off the loan. The way to do that is if you know what the loan is and you know the interest rate, you can figure out what the payment has to be. And then I broke down each payment into how much of it was going to be interest and how much is principal. Why do I care? If I'm going to pay $61.8 million every year to my debt holders, and I want to compute cash flows after cash flows to debt, why do I care what's interest and what's principal? Yeah.
You have tax implication of the interest is deductible.
Only the interest is tax deductible. Something you find out very quickly when you take the 30-year mortgage is in the first month, almost everything you pay is interest, which you think of as good news, but it's also bad news. It's good news because you get a big tax deduction. The bad news is if you look at how much principal is due after the first month, it's almost exactly what it was before the first month. By the time you get to the 360th month of a 30-year mortgage, and nobody kind of hangs out in their house anymore for 30 years, almost all of that same payment will be principal. That's what you're seeing here. Initially, you see interest be big, but as you get down towards the end, it's almost all principal. I break it down to interest and principal. I need to do this because I'm computing cash flows to equity investors. So that's the first stop, is if you have debt on a project and you want to look at cash flows to equity, you have to break down into interest and principal payments. Next step in the process is I need a hurdle rate. I need to figure out what discount rate to use to judge this project. Now remember, I'm doing everything from an equity perspective, right? And I'm doing everything in US dollars. So I need a cost of equity in US dollars. And the cost of equity that I came up with in US dollars for iron ore, which was the portion of Vale's business that I'm looking at, was 11.13%. But you're saying, but the mine is in Canada. You're right, the mine is in Canada, but you sell the iron ore to China still, right? Canadians don't build ghost towns. You need big iron ore, somebody who's consuming a lot of iron ores. So in this case, I'm going to stay with that 11.13% as my cost of equity. Is everybody clear? Because in a sense, when you pick the discount rate, it's already picked for you based on how you computed the cash flows, but they're to equity, and in what currency. If I'd computed the cash flows pre-debt in reais, I would have used a cost of capital in nominal reais. So there are a lot of different discount rates here, but the one I'm using reflects the project I'm looking at, what business it's in, and the currency that I've chosen to do the analysis in, and the fact that I'm doing everything after debt payments. So my hurdle rate that you're going to see for this project is 11.13%. Any questions? I know there are too many numbers on this page. Don't focus on most of them. Okay? Here's what I'm going to try to do. I'm going to compute the net income on this project. One of the problems with this section of corporate finance is I will be testing at least the basics of accounting to see how much it's sunk in. And one of the ways to test it is to throw an earnings number at you and you're saying it's earnings. So when we did the Rio Disney theme park, I looked at operating income, right? Here I'm looking at net income. The difference is operating income is before debt payments, net income is after debt payments. So when I compute my net income, I will be subtracting out interest expenses, which I did not do when I did the Disney theme park. I'll be computing taxes on my taxable income, which is after interest expenses, and my net income is right there. I also compute my book value of equity, as opposed to what? When I did the Disney theme park, I looked at the book value of overall capital. Here I'm focusing just on equity, which means I subtract out the debt. So everything is done through equity eyes. And in fact, if I divide that net income by my book value of equity, I end up with a return on equity, as opposed to the return on capital that I got for the Disney theme park, of roughly 31.4%, which is higher than my 11.13%, which would suggest to me that to the degree that I trust my return on equity, I should be taking this project. My only warning is when you have finite life projects like this one, the return on equity as you get towards the end of the project will look astronomically high. You know why, right? Why is that happening? In the case of the Disney theme park, that didn't happen because I was investing back into the theme park. Remember those capital main? If you don't put money back into a project, this is exactly what will happen, is your book equity will shrink because as you depreciate, the asset will become less, and your return equity by the time you get to year 7, 8, 9, and 10 will reflect the fact that your assets have pretty much been depreciated. So what I'm saying in a long-winded way is in finite life projects, be very careful about the return equity over time, because this is a pattern you'll almost always see. So if I trusted return equity, which I don't, this would be my measure of, is the project a good project? Is everybody clear on the mechanics of what we're doing, the difference? In fact, set the Rio Disney analyses next to this analysis to see what I'm doing differently. Because if you can crack that code, it's a very critical part of understanding how to analyze a project or how to value a company. It's firm to cost of capital, equity to cost of equity. Stay consistent all the way through. Now remember when I did return on capital for the Disney theme park, I took that tangent and computed the return on capital for the whole company, compared it to the cost of capital. I could do the same thing with return equity. I could compute a return on equity for a company and compare it to the cost of equity. I'll get a spread, just like I did with the return on capital. So instead of having a capital return spread, I can look at the spread on cost of equity. I do this all the time with banks because to me this is the driving variable in determining why some banks get valued highly and some banks don't. There's no point computing a cost of capital or return on capital for a bank because debt is almost indefinable. But I can compute equity, and equity for a bank actually means something, right? Because it's based on regulatory capital requirements. So if you're earning a 15% return equity and you have 11% cost of equity, you are a good bank. If you're earning an 8% return equity and you have 11% cost of equity, then you're in trouble. So that's why regulatory capital requirements affect you as a bank, because they affect your return equity by raising how much equity you have to invest to get the same amount of income. So that's the return equity measure. And for non-financial service firms, just remember that this approach will give you much more volatility because the equity is the smallest slice of the company, so your return equity can be astronomically high just before it goes negative. So be a little careful about return on equity for non-financial service firms because the book value of equity in highly levered firms is a very small number. Can it be negative in the book value of equity? Yeah, it can be negative, in which case don't even compute this because it becomes meaningless. Now, just as I did for the Rio Disney theme park, I'm going to take my income numbers and make them into cash flows. And what are the three adjustments I had to do that for free cash flow to the firm? To go from operating income after taxes to free cash flow to the firm, I added back depreciation and amortization. I subtracted out capex. I subtracted out change in working capital, right? I'm going to do those three changes, but I'm going to throw in a fourth change in here. Remember, I already computed the interest expenses and took them out of net income, right? But what have I not taken out yet if I'm looking at cash flow to equity? I have to repay the debt. The principal repayments on the debt now have to be brought in because I'm the equity investor. I've got to pay those guys. My free cash flow to equity is what's left over after those debt payments. So that's what my equity investors are going to see from this project. And remember, the salvage value will show up in year 10 because that's the year that I wrap up the project. And those are my cash flows to equity investors. Of course, there's a big negative up front because I have to invest. And then they start small positive, and over time they become very big positive numbers. So everything is done after debt payments. Last step in the process, I took the cash flows to equity. They're in US dollars, they're in equity cash flows, I discounted them back at the cost of equity. What I get as a net present value for this project is roughly $304 million. So if I'm your number cruncher in your wallet, you took this project, you'd be basing it on the fact that based on my numbers, the net present value was $304 million. I did everything in nominal terms or real terms. So you have 50-50 shot, might as well just give it a try. Take a risk, pick one. Nominal terms. You said nominal, yeah, it is nominal because, you know how you know? Because I told you that the cash flows were in US dollars. The minute I mention a currency, the nominal terms, what's the inflation rate I've built in then if it's in US dollars? It's the inflation rate in US dollars, which might be 1 or 1.5%. If I'd done it in nominal REI, the inflation rate built into it would have been 7 or 8%, so it'd have higher cash flows, higher discount rates. But could I have done everything in real terms? What would that require? First, I'd have to go into my cash flows and remove the effect of inflation, right? So I'll come back to this. I'd have to remove the effect of inflation, which would make my cash flows lower. Yeah. It is sold in US dollars, but I can make it real anyway, anytime I want. What it requires then is take out that 1% inflation. So that makes my cash flows lower. I think this is bad. But then when I go to my discount rate, you know what I'd have to do? To go from nominal to real, I'd have to take out that same inflation out of my discount rate. So just as currency doesn't matter, whether you do things in real or nominal shouldn't matter either. You know what does matter is if you do your cash flows in nominal terms and decide to use a real cost. Then you're going to be in trouble. So the same message I had with currencies applies here as well. If you choose to do everything in real terms, just stick with real all the way through. Okay? Previous page, I just did an internal rate of return, just as the NPV said that this is a great project. The IRR sends the same message. This is a great project. But that was not even that long ago. When I wrote this book, a year and a half, 2 years ago, when iron ore prices were $100 a ton. You know what they are right now? They're about $60 a ton. If I were the analyst doing this analysis, you got the firing squad ready for me, right? Saying, you screwed up. And I'm going to say, not my fault. I gave you the assessment based on iron ore prices then. It goes back to that point I made about Rio Disney, which is you have estimates, you make the best decision you can on those estimates, the entire world can shift under you. So the last piece I want to do here is ask you to put yourself in the shoes of a decision maker at Vale, and let's go through some of the things that can affect your decision. Okay. The first is the iron ore price. Remember I did it at $100 per barrel? I actually, as part of the analysis then, I computed what would happen to the net present value if the iron ore price went to 90, 80, 70, 60, 50. So I sent you a warning, you just ignored it. It was in that exhibit that I added on at the end. So at $100 it's a great project, but at 80 something dollars it becomes break even, and at 60 it's a horrible project. It's neither here nor there, but you can see how the net present value changes. You know the other thing that's going to affect this net present value? Vale has a lot of its costs in Brazil. It pays its employees in nominal reais. It sells its goods into a dollar-based market. It collects its revenues in US dollars. Exchange rates do matter for you then, right? Because if the dollar strengthens, you actually should be in better position now because your margins will get much better because what you're paying in reais will now be less in dollar terms than they used to be. If the dollar weakens, it's going to hurt you. So in this case, what I did was I looked at what would happen. In this case, I looked at the Canadian dollar and the US dollar because the costs are all in Canadian dollars. If the Canadian dollar gets weaker, the net present value rises. Why? Because all your costs are in Canadian dollars, all your revenues are in US dollars. If it strengthens, there are pretty much every large company in the world today is looking at a chart like this one. Right? Because the dollar strengthened by about 15 to 20% in the last year. There are projects that probably looked great a year ago that you took, that you now are looking back saying, I wish I hadn't done that. So this is reality. If you're a commodity company like Vale, you're going to be affected by commodity prices and you're going to be affected by exchange rates. And that worries you, right? So because it worries you, what can you do? You try to protect yourself against that risk, which means you try to hedge against that risk. So I'm going to put you in the position. So it's not fair using hindsight, saying if I had known then that the price was going to go to $60 a barrel, I'd have hedged. Because if you'd known then the price was going to go to $60, you wouldn't have hedged. You wouldn't have taken the project in the first place, right? So this is about whether you should hedge. Okay, I'm going to give it to you in pieces. Let's see why your answers might be different for each piece. First, as the CEO or CFO of Vale, you could have hedged against iron ore prices. There's a futures market out there. You could have hedged against iron ore prices. Obviously, in hindsight, it would have been great on this particular project. But as a generic decision, should commodity companies that get their revenues from that commodity hedge against commodity price risk? And if the answer is yes, under what conditions? You see what I'm asking? Should an oil company hedge against oil price risk? Should a gold mining company hedge against gold price risk? Should a commodity company hedge against output risk? But if you're an oil company, who are your customers? You don't sell to a person, right? You sell into the oil market. So you don't sell to an individual, you sell into an oil market. If you're gold, so in fact, all commodity companies, you almost never, if it's output, have direct relationships with your customers. You sell into a market and customers then come into that market, buy, sell, etc. Do any of you have stock in an oil company? Okay. Let me ask you a question. Which oil company do you invest in? I won't ask you when you invested because that might, was it at a good time? Okay, you invested in when? I'm not sure that's so fantastic anymore, right? Fantastic? I thought you were going to say December of 2014. Let me ask you a question. When you invested in ExxonMobil like you did, why did you invest in ExxonMobil? What about Exxon attracted you? Higher, so you bought it because it was a safe bond? You weren't buying the bond, you were buying the stock. God, that's a conspiracy theory of Exxon. Right? I mean, let's face it, you didn't buy ExxonMobil, who's an incredibly well-managed company. And how does it pay the dividend? It comes from earnings and or you invest in Exxon because it was an oil company, right? Most people invest in commodity companies because they want to make a bet on commodity prices. I bought Lukoil, December, not because I love Russian oligarchs or I love country risk, but because I wanted to make a bet on oil prices, which were then about $60 a barrel, going up. Of course, that bet's not paid off yet, but I still hold Lukoil because to me it is my bet on oil prices. Do you see where I'm going? If Lukoil now goes and hedges against oil prices, then let's say 2 years from now I turn out to be right and oil prices go back to $100 per barrel. I look at my Lukoil stock price and say, what the heck happened here? Why aren't your earnings up? And they say, well, we hedged against oil price risk. I'm going to pretty much hit the roof. I don't invest in commodity companies because I love the management. What the heck are they going to do besides watch the price? I invest in commodity companies because I want to make a bet on commodity prices. The worst thing you can do to me as a commodity company is go and hedge against a very variable that I'm betting on. That's what happened to Barrick Resources for a decade in the gold mining business. They kept hedging gold prices as gold prices went from $200 a barrel to $1,100 or $1,200. You're saying, but it helps them on the way down. It doesn't matter. Even if you make money on the way down, I'd rather you did not do this because if I don't want to be exposed to oil prices, there's a very simple solution I can take. Don't invest in an oil company. And if I want to bet on it going down, then I'll go buy oil futures or sell oil futures. If I want to make a bet on commodity prices, I essentially want you to do nothing with your output variable. But I'll give you the one escape hatch. I want Vale to hedge against some of its iron ore risk. Here's why. It owes a lot of money. You know why that's a problem? Lukoil doesn't owe very much money. So if oil prices drop to $30 a barrel, they stay there, they're going to be okay. Their debt ratio is only 10%. Vale's debt ratio is 50% and climbing. If iron ore prices drop by another 15 or 20%, they're going to be potentially in default. You think, so what? Well, then the game ends for me. Even if iron ore prices go back up 2 years from now, they're not going to be around. If you're a highly levered commodity company, I'm going to give you an escape hatch and say you can hedge, but because you are exposed to default risk. ExxonMobil shouldn't even be thinking about hedging. The debt ratio for ExxonMobil is 3%. You are in fact in the perfect position to ride out whatever happens to oil prices. Don't go looking for trouble. So hedging with output variables is always dangerous unless you can give me a really good reason why you as a company want to, and it won't be 100% of your output, it might be 30 or 50%, it's to prevent that truncation risk. So that's with an output variable. But you also have input variables, right? In this case, exchange rates affect your costs. So this is a different issue I'm asking about. Should you hedge? Again, exchange rates happen to be. Currency is actually the most hedged. So if you look at hedging, I think 60% of all hedging in the world happens around exchange rates. So it should be good, right, if everybody does it, but I've discovered that's not always the best indicator of good sense, that everybody does it. Let me ask you a question. Should you hedge against input variable? Should Hershey's hedge against the cost of sugar? Right? It's a different issue, right? If you hedge, what's the payoff? What's the benefit of hedging? Your costs are more predictable. Your earnings should be therefore less volatile. Is that good? It depends, right? Because in a sense, it depends on whether investors care. You say, why wouldn't they care? If I know that your earnings are going up and down because exchange rates move, I'm not going to freak out. In fact, when you see these companies report big earnings surprises and it's entirely because of exchange rate effects, the price effect is almost non-existent. Markets know when an earnings surprise is a really bad surprise and when it's caused by exchange rate movements. So if I'm invested in Coca-Cola and this year they report a big drop in earnings, to the extent that that big drop is because the dollar got stronger, I'm okay with it. You know why? Because what one hand gives, the other hand will take away. Over time, I'll have other periods where I'm going to make a lot of money when the dollar gets weaker. I know you're saying, do investors look forward that? They seem to. A pure exchange rate earnings surprise seems to have no effect on stock prices. But it does make your earnings smoother. And if you're a manager, there's a benefit there, right? Why? You won't get fired. The reality is the reason I think there's too much hedging in the world, to be quite honest. But the reason there's so much hedging is who makes the decision on whether to hedge? It's not you and I as stockholders. It's the managers in a company, and it's much more comfortable being the manager of a company with smoother earnings than more volatile earnings. So I can understand why you're doing what you're doing. If you can do it at low cost or no cost, I'm okay with it. And exchange rates, especially if you're hedging against the euro or the Canadian dollar, should be pretty cheap to do. I can live with it. It makes you more comfortable as a manager to make the right decisions. But if you're bearing large costs to hedge against input variability, then I'm going to come back and say, do you really need to do that? Why don't you just let it pass through to your investors and let them deal with it? Right? So on each of these, what you do will vary. So with the Canadian dollar, you might decide not to hedge because the variation is small, but against a nominal real, if you have a lot of debt, you might say, hey, one big movement. I mean, the real, when I did this a year and a half ago, was I think 2.35 reals per dollar. Today it's what, 3.15 reals per dollar. There can be huge moves. And that could mean the difference between making a lot. The one thing I don't want you to do as a company, though, is go in and out of the hedging market where you decide when to start hedging and when to stop hedging. Because then I know exactly what you're going to do. You're going to start hedging at exactly the wrong times. You're going to stop hedging at exactly the wrong times. I get the worst of both worlds. And that's my problem with how airlines hedge. There are two airlines that hedge consistently, Southwest and Singapore Air. They hedge all of the time. That I accept. So they're saying, look, we want predictable costs. But you look at United or American, they hedge when the CFO feels worried about about oil prices, which is exactly the time that I stopped feeling worried, because when CFOs of oil companies say, I'm worried about the oil price, that usually is a sign the oil prices are going to go down. So it's usually at the wrong time. So if you're going to hedge, at least do it consistently. Don't try to time the market, because you're not going to be able to do it. So here's a picture I drew a couple of years ago for a CFO who asked me, can you he said, this is too confusing, too many issues going around. I said, let me put in a chart and see if this, so let me take you through this chart and put yourself in the shoes of a CEO or a CFO. And you're thinking about, should I hedge this risk? So the first question I'm going to ask you is, what is the cost to you of hedging this risk? What are the three ways you can hedge risk? You can go to the derivatives market and buy futures or options, which you might have. You can have an investment bank create a synthetic, and they'll create a synthetic hedge for you against pretty much everything at a cost, or you can use insurance. Remember, insurance is the oldest hedging mechanism out there. Don't ignore it. Okay? It's certain kinds of risk. So the first is, what's the cost? If it's zero or very close to zero, I say go do whatever you want. It really doesn't hurt me. And if it makes you feel a little better about the future, then I can let it go through. If the cost is significant, then I'm going to ask you, is there a benefit that you see in terms of having a higher expected cash flow or a lower discount rate? In other words, show me where it's going to. And you can't just tell me, if I hedge, my risk is lower, and my risk is lower, the discount rate is lower. Why isn't that rationale always going to work? What makes my discount rate higher or lower? It's my exposure to risk I cannot diversify away. So if you're hedging away risk that I would have diversified away anyway, then it really has no effect on my discount rate. So is there a benefit that I get from my cash flows or from my discount rate or survival if you have a lot of debt? Show me what that benefit is. The benefit is significant, then I'm going to ask you a follow-up question. Can your marginal investors, don't forget them, remember those 17 top investors in your company? At BlackRock and Fidelity, can they take care of this risk? And you know what? 8 times out of 10 you're going to say, well, they can take care of this risk at 2 levels. One is if you have 100 companies with exchange rate exposure, the exposure that you have to hedge is across the 100 companies, which will be far less than each of the 100 companies hedging the risk. So if they can hedge it cheaper, ask yourself, will the benefit still be there if my investors hedge instead of me? If the answer is yes, let the risk go through. Let them take care of the risk. You don't have to carry the burden of eliminating risk if your investors can. If they cannot, then go out. In other words, I'm not ruling out hedging. I'm saying we have to think through this process a lot more systematically than we do right now. You cannot let the people selling hedges tell you when it makes sense, because they're going to come with charts and they're going to say if you do this, your earnings are going to be more stable. And you're going to buy the hedge because they tell you it makes sense. You have to think through this yourself if you're a business. And you can already see that for different businesses and for different types of risk, you're going to come to different judgments. Any questions? In fact, one of my books is called Strategic Risk Taking. It's if you're interested, you can borrow a copy from me. It's not a valuation book. It's not a corporate finance book in the traditional sense. It's about how we think about risk. Because to me, one of the problems with risk management as practiced today is it's become almost entirely a defensive crouch. It's about how to avoid risk, how to hedge against risk. To me, great risk management actually first requires that you put risk into 3 buckets. The first bucket is risk that you want to pass through to your investors. Let them take care of it. So if you're an oil company, let them deal with the oil price risk. The second bucket is risk you want to protect yourself against for whatever reason, because you have too much debt or because it will cause your own. The third bucket is risk you want to actually seek out and take. You're saying, that's crazy. Why would I want to do that? How do great companies become great? Not by avoiding risk, but by finding the risks on which they have a competitive advantage. So when you think about your company, start thinking in terms of, draw up a risk profile, everything that can affect your company, and start thinking about which bucket you think you would put each risk into. So now let's talk about the biggest investment that most companies make, which is through acquisitions. To me, one of the big problems with acquisitions is the rules for acquisition seem to be different than the rules we follow for traditional capital budgeting projects. And if any of you worked at companies, you probably notice this. You come up with a $50 million internal project, they make you jump through 16 hoops. Come up with the cash flows, adjust the discount rate. Did you think about this? Did you think about that? Go back and redo it for a $50 million project. You know the best way to avoid all of this? Suggest a $15 billion acquisition. It's amazing how things just fly through. And I've never understood this. If you're going to make me jump through 16 hoops for 50 million, shouldn't you be making me jump through at least as many hoops with 15 billion? And it's amazing how many first principles in corporate finance get mangled when you do acquisitions. In fact, just remember what we've done so far about capital budgeting and start thinking about an acquisition as a big project, and you're already going to see what you need to do. So to do this, I'm actually going to take an example. So we've used Disney already, we used Vale, let's use Tata Motors. Let's assume Tata Motors is thinking about acquiring Harman Audio. This is actually a company, you've probably seen their high-end speakers. It's a US audio, basically it makes speakers, headphones, etc. It's thinking about buying it because it wants to use their high-end audio equipment on not their Tata Motors cars, but on the Jaguar Land Rover cars. So they're buying it. There's that undertone of, when I say they're going to use it in their cars, what am I talking about? Synergy. So we'll come back to that. For the moment, let's start with how should I value Harman if I'm Tata Motors looking at the company. First, when I'm valuing Tata Motors to decide how much to pay for it, should I do my valuation in US dollars or Indian rupees? The answer is it doesn't matter. Which one's going to be easier to do though? It's going to be in US dollars because I'm buying a US dollar company, all its finance. Why go through the trouble of contorting myself? So I might as well leave it in US dollars, which means my discount rate has to be in US dollars. I did compute Indian rupee cost of cap for Tata Motors. Can I just adjust it and make it a dollar cost of capital and use it on this valuation? Tata Motors is an automobile company, right? This is a audio electronics company. So none of the things I've computed for Tata Motors really even mean anything right now because it has nothing to do with this investment. This is the first rule in acquisitions. Don't take the acquiring company's cost of capital and go crazy with it because it has nothing to do with the process. They might be coming up with the money, but it's the target company's risk that drives it. So the first stop I made was I decided to do everything in US dollars. For the beta, I used the beta for electronics companies in the US. Not Indian automobile companies, not global automobile companies, and that beta is 1.17. For the equity risk premium, I looked to see where Tata Motors gets its revenues. I'm sorry, where Harman gets its revenues, because I'm buying Harman, I'm not buying Tata Motors. So there's the breakdown of revenues. And for the debt ratio and cost of debt, I'm going to stay with Harman's cost of debt and debt ratio. And that might strike you as a strange thing, because you know, what if Tata Motors can borrow money at a lower rate or can borrow a lot more money? Let's say it can borrow all of the money for this acquisition. It's a lot of debt capacity. Why shouldn't I use Tata Motors' lower cost of debt or debt capacity in valuing Harman? I'd pay a much higher price, right? I'd get a lower cost of capital. I'll pay a much higher price. And think about what you've just done. You've rewarded Harman stockholders for something that they had absolutely no role in creating. There's a rule in acquisitions: render unto the target company stockholders that which is theirs and not a cent more. If you subsidize an acquisition because you have cheap debt or you have access to cheap debt, you are overpaying for all the wrong reasons. Yeah. It is synergy. We'll come back to because there at least you can make an argument of cash flows. This is pure subsidization, right? Synergy we can ask about. Maybe I should get my share of it, but using your debt ratio and cost of debt is a recipe for disaster. Yes. Okay. No, I think I'm being absolute, because when we talk about synergy, you can separate the synergy out, and that part, you know what I'm going to let you use? A weighted average cost of capital of the audio. In other words, I can't be attaching that discount rate to the rest of Harman's products. If you told me Harman's going to stop selling speakers and stop selling headphones and sell only audio, that's different. Then you can say, look, the business is going to change. I'm going to come up with this weighted average. But to the degree that this is their existing business, I can't attach it. But when we talk about synergy, that's where we're going to come back to this question of what's the right discount rate there. And that's a much more debatable point, because that's going to be it's essentially an accessory to maybe an automobile cost of capital would make more sense there. So the cost of capital that you're going to see me use, so this actually makes your life easier, right? Because what have I said? To value a target company is compute the target company's cost of capital as if nothing's happening, and use the target company's cost of capital in the cash flows. And to get the cash flows for Harman, here are the assumptions I'm going to make. You're saying, where's the synergy? Hold on to the synergy, because we'll come back and deal with it separately. This is Harman standing alone, generated $201.25 million in operating income in the most recent year. They had a one-time charge, which actually looked like a one-time charge. You know what I'm talking about? Lots of companies have one-time charges, but you look at it in every year, they have a one-time charge, at which point it's really not a one-time charge, it's a 10-time charge. Okay? This is really a charge that seemed to show up only in the most recent year. And I'm going to take them at their word that this is non-recurring. It's not going to happen again. The reason it matters is I'm going to add back that expense saying it's done. It's not going to happen again. So my expected operating income is adjusted for that one-time charge, and I'm going to use that as my base year income. The company paid an 18.21% effective tax rate, and it did reinvest a significant amount during the year to kind of keep growing. So this is nothing to do with Tata Motors. This is Harman as a standalone company. These are the earnings and the reinvestment. Just as I did the cash flows in the project, I started with the revenues, came up with operating income, netted out taxes, add depreciations. It looks just like my Disney theme park, right? It's just for the whole company. The cash flows I get for next year are $166.85 million. Big jump because I don't have the one-time charge and I'm normalizing things. I'm going to keep my life simple. I'm going to assume that Harman as a standalone company would have been a mature company You say, what if it had been high growth? Then I'd have to project out 10 years of cash flows to do it. It's not a big deal. And discount these cash flows back at my Harman cost of capital. So I used a 2.75% growth in perpetuity, Harman's cost of capital, to come up with a value of about $2.476 billion for the operating assets. So that's what Harman's operating assets are worth. They did have $515 million in cash, which I added. I subtracted out their outstanding debt. The value that I get for Harman as a standalone company is $2.7 billion. Tata Motors, if they wanted to buy Harman in the market today, would have had to pay $5.4 billion. So if Tata Motors came in and said, we just want to buy Harman as a standalone company and we're going to do nothing, I'd look at the cash flow and say, that doesn't make much sense. But you know why the analysis is still incomplete, right? What have I not assessed? It's the value of synergy. So we'll come back to this. If the value of the synergy is greater than 2.something billion, 2.75 billion, the acquisition makes sense. There's this canard about how we in finance, at least the skeptics about mergers, view synergy. The canard is that we think synergy doesn't exist. That's not true. We think synergy does exist, but I think we routinely see companies overpaying for that synergy. Why? Because they don't even put a number on it. Synergy becomes a plug variable. So the way this would have played out in Tata Motors is the CEO of Tata Motors would have said, I want to buy Harman, deliver the numbers that back up what I've already decided to do. People would have ground through the numbers, they'd have tried the 9.67%, it wouldn't have worked, they'd have tried a lower discount rate, they'd have done some contortions, come up with maybe $4 billion, and then advise me to pay $6 billion and say, don't worry, there's synergy. How much? Enough to cover the difference. Have you looked at the numbers? No, we don't. That's the problem with synergy. If you're going to pay for synergy, you might as well face it, value it, and then decide whether you've overpaid or underpaid. So we've looked at three separate analyses. We start with Rio Disney. So start with that, looked at the numbers. So when you sit down to do the case, you'll have to make some decisions. Are you going to do things on a basis of looking at the entire business or just the equity in the business? The currency choice I've taken out of your hand. I think I've given you everything in US dollars. If you want to make your life difficult and do everything in Russian rubles, be my guest. You can do it. You can basically convert into any currency you want, right? And then you have to work through the process. Just be systematic about how you're doing it. So don't jump steps. Think about what the right cost of capital or discount rate is for this particular project. The Apple iCar, right? And think through what the end result should be. I almost never finish a class early, right? I think I'll make an exception today. Okay. Okay.
You said if Tata Motors uses the cost of capital of itself to acquire Harman, how does it reward the debt holders of Harman?
Not the debt. If they use their cost of debt, their debt capacity to fund, then they're lowering the cost of capital because they have access to cheap debt. If you lower the cost of capital, you increase the value. If you pay that value now, you've effectively paid Tata stockholders something that they had no role in creating. Right? So you have debt capacity, you have a low cost of debt, congratulations. But don't take that and plug it in.
But it benefit the equity holder, not the debt holder.
Not the debt holders. Hi.
Was depending in the case about the cost of capital, we calculated it, we took the beta for cars in the streets and added it to the weighted and inflation and all this. This is the way, or just to take the car industry beta for the cost of
What do you
capital?
mean by inflation? What does that mean?
No, I mean because I wanted to do a weighted average.
Right.
So right now what I have is the data of revenues that accumulates to 100%, and you want to add the car.
Revenues for Apple?
For Apple, for the entire break.
You'll have to make that decision. Unfortunately, I can't answer that question. Just use what we talked about today to give you the answer. Think about the Harman acquisition. This will kind of give you the answer. Hi.
So in the example you were saying for commodities company, that if they're large and successful, they don't need to hedge.
It's not that they're large and successful. They're large and lightly levered.
Okay.
They don't have very much debt.
that
They can be small and, so the lightly levered rather than the large or
Right.
small.
I I guess it's the leverage factor. If you have a company that is highly levered but is doing well,
Doesn't matter,
Doesn't
right?
matter.
Because at the current prices, it could be doing well.
okay.
But what you worry about is a lot of
Can they repay the debt?
shale oil companies 2 years ago were doing really well. But the shale oil companies that borrowed money based on doing well are now in deep trouble because so that's what you worry about. If things continue to do well, then it doesn't matter.
Can ever those decisions about commodities company hedging on its own commodity be used as a signal to change how the markets will interpret that information?
The problem is that information won't even get to the market till way after it happens, right? It'll usually be in an annual report buried in the footnotes. You never actually see the company. It won't make an announcement saying we're starting hedging today.
Right, because I guess I was wondering, would
that'd be a
that
good
would
that'd be a
change
signal, right? So as an
Yeah.
investor, if you see a oil company starting to hedge, you think, oh my God. Luckily, there's a lot of noise in this process. A lot of companies hedge when they shouldn't be hedging.
Okay.
Yeah.
Okay. So it's
But-
just they're not as systematic about
Exactly,
what they do.
yeah.
Okay. Great. Thanks.
I had a question for you about subsidization, but I'm going to skip
Yeah.
that because I noticed you didn't use market value of equity for Harman.
I did.
Because you're saying the market value is a 5.4.
Yeah.
So if we use your
So-
financial balance sheet, the company's worth 4 billion because you take out the debt. So it's
But then you haven't done a valuation, right? You're buying cash flows. So after you buy this, it doesn't matter what the market thinks about it. It's like my buying Tesla, right?
how can it not matter what the market?
It can't matter because that will determine what you pay.
Yeah.
What you get in return is cash flows. Like after I buy the company, I can't go to the market and say, well, the market, you charge me 4 billion, so it should be worth at least 4 billion. Market, after you've acquired it, now becomes part of your cash flows.
Yeah.
So what you get is cash flows. What you pay is determined by the market price. So what you pay, that 5.4 billion is going to be the floor on what you're going to pay. You probably have to pay a premium on that. So you're going to be probably paying 6.2 billion. But after you've paid that, what you acquired is a set of cash flows.
Yeah.
Set of cash flows from selling electronics, which you value, and a set of cash flows from synergy. Right? The combined value of those cash flows better be greater than 6.2 billion. Right? Because at that point you can't, what you paid was driven by the market, but what you get back has to be earnings and cash flows. Because the market after you acquire it is not going to give you a higher value because you own
So
Harman.
really you're saying that, are you making the case to pay for it in stock?
You could if Tata Motors is overpriced as well. Right? that can become a factor. If Tata Motors is also overpriced, then you can say, look, I'm going to pay with cheap currency for something that I think is... So Facebook, when it paid for WhatsApp, paid 16 billion to 19 billion in shares.
Yeah.
I don't know whether they did it because they thought their stock was overpriced, but they're probably regretting it now because they paid when their stock price was 48 and it's now 75. Right? So when CFOs say, I'm going to pay with my stock because I think it's overpriced, here's the other problem. CFOs almost never know when their stock is overpriced or
It's just that
underpriced.
if you come up with a valuation that's 2.5, the market says it's 5.2, and you probably have to pay 6, then you should definitely not pay cash.
But there's also another option. Right? Nobody's asking. That's the thing. That's what gets us into trouble in acquisition. Is you decide you have to do this acquisition. Then you have to do all kinds of contortions to get to 6 billion, right? So you can change the cash flows and say maybe this will happen, maybe that will happen, maybe this. But there's that option of hey, just get up from the table and leave. But that's a behavioral problem. Is once a CEO commits to doing something, it's that macho thing. It's not even nothing to do with whether the CEO is male or female. It's you can't walk away without a loss of face. And then, of course, they're using your money to cover, and that's, I think, the biggest problem, is if more companies were willing to get up and walk away from the table. And especially with publicly traded companies, it's critical you do this, because what will happen is you announce an acquisition, the price will start climbing. So you're paying a premium on a price that's already climbing on top of a previous price. You're paying premiums on top of premiums. And it's a very difficult game to win once those premiums get built in.
Once you walk away, everybody's stock price.
Well, it depends, right? When you walk away, your stock price might have an initial disappointment, but if you look at over time, the companies that lose acquisition battles do significantly better than companies that win acquisition battles. So when you have two bidders for the same company, I'd much rather be a stockholder in the losing bidder than the winning bidder. It's winner's curse in auctions.
Question about the hedging of the oil prices. So I understand it from an investor point of view,
It's
right?
the only point of view that matters. Companies
But
are legal entities.
But when we look at investing in a project, why don't we take it from the manager point of view? Of
Manager is an employee. That's if I hire. Let's make this simple. Let's suppose I have a corner grocery store. You're
Right.
a manager. Your point of view. is completely irrelevant. I pay you to be a manager,
Right.
right? I want you to run the grocery store for me.
Right.
There is no manager point of view. There should not be. You get paid.
Is that only if it's a publicly traded company though? Because I mean, if it's a privately traded, I mean, if it's a
It's
private
even
company.
more, even more of a, if you're a private owner and I'm your manager and I told you, look, I'm going to do this because I think it's in my interest. You know what's going to happen to me? You're the private owner. You hired me as a manager and said, well, I think my interest suggests we should do this.
What,
What's your answer going to
well,
be?
well, why would it be in the manager's interest specifically? Because so the way I see it is, if you can hedge against losing out on money for investing in that
Hedging
project.
cuts both ways. When you hedge against losing, you're also hedging against winning. You can't have a one-sided hedge. There's
Right.
always a cost.
No, I
right?
understand. But if you can guarantee that you at least make over your NPV or over NPV of zero.
I'm still leaving
positive
some
NPV.
NPV, so I'm still leaving NPV on the table, right?
Yes.
So I'm getting $500 million rather than $1.5 billion.
But it's almost guaranteed $500 million as opposed to
No, it's not. All you're doing is protecting against oil price risk.
right.
The rest of the risk, interest rates, inflation, it's not going to be guaranteed in any sense of the word. All
Sure,
you can
but
do-
it's a little bit more guaranteed.
I'll tell you what, if you guaranteed against all the macroeconomic risks,
Then you
your
go
net
ahead and
present
hedge.
value is going to go to zero.
Okay.
There's no, in fact, if you said, look, I'm going to take a project, there's 16 risks, I'm going to hedge against each one of them. I guarantee you by the time you finish hedging the 16 risks,
That'll be zero.
zero. And if you make more than zero, that's arbitrage.
Right.
The definition of arbitrage is you hedged away all risk. You don't even need to deliver 500 million. Deliver $5, right? If you hedged away all risk, $5 is good enough for me.
Okay.
Right? And the only place you will be able to do that is in financial markets where you have financial assets where you can actually, so if you find a mispriced financial asset, you might be able to do that. In real markets where you have to invest in an oil mine or a theme park, a lot of the risk you can't hedge against, right?
Right.
I have a theme park, somebody catches measles in my theme park, 100 people sue me. How do you hedge against that, right?
Okay.
So that's why you get the illusion of being safer because you've hedged against the risk.
I see.
But my question is at what cost? Right?
Okay. Thank you.
My
Yeah.
question sort of follows this logic. Not necessarily a privately owned business, but even if you have one stockholder who owns 51%, and most
Is that
of their,
stockholder diversified?
so let's say that it's like Mark Zuckerberg can't be diversified. Most of his wealth is Facebook.
Yeah.
He can diversify away the specific
So
risk
he
of
might
Facebook.
decide to hedge against risk that I don't want him hedging against. It's a potential conflict of interest you have in closely held companies. That what's good for the lead stockholders running the company might not be good for the rest of us. It actually shows up in some very perverse ways. So the extreme scenario where you worry about exchange rate risk is you don't invest outside the domestic market, right? Because you say, if I invest outside the domestic market, there's exchange rate risk and I can't deal with it because I have all my money tied up in the company. In fact, there's studies that show that especially with smaller closely held companies, they tend to be less willing to grow geographically because of that. So you will be a smaller, more conservatively run, less valuable company as a consequence. And when I price your company, I've got to factor that in. I can ask what's a sensible thing. They should be in China because that's where the growth is. They're a construction company, European construction company, run by managers who have a lot of wealth tied up in the company, and you choose not to invest in China because you worry too much about that risk. I have to factor, when I do my valuation of you, I have to factor that in when I do your expected growth, your return on capital, your value as a company. It'll be lower than what it would have been if in fact you'd been,
But it would still make sense for that specific company to hedge or not to go into China because they're...
it depends on how
main
Mark
investors.
Zuckerberg thinks about his wealth, right? Would he rather own $30 billion worth of a company that's worth $100 billion, or because in a sense you live in the reflected glory of what other investors think about you, right? So if you decide not to hedge and you go out and you're much more daring and aggressive in your plans, you do expose yourself to more personal risk because you got so much of your wealth tied up in the company, but you also will get much more value for your company. And the question you got to ask is, if you're Mark Zuckerberg, your value is 14 billion or 38 billion or 57, it's not going to put a dent in your lifestyle.
Yeah.
So it turns out that when you get to companies the size of Facebook, you don't have people running the company as if
As if it's their own life.
it's as
But
if
maybe with
with the
Bookscape.
smaller, especially with really small, Bookcape is private business, but if it's a very small, closely held public companies, That's something you got to be careful about when you value these companies, because the owners of these companies will tend to be much more conservative about how they run these companies because they worry about the personal risk component. So they borrow less than they should. They'll take less risky projects. They